This is a video about accounting.
Thanks, kiddo. Hi, everybody. Welcome to this video about inventory valuation. By the end of this video, you should be able to define key terms related to inventory valuation, such as historic cost and net realizable value. You should also be able to calculate and interpret a variety of performance ratios related to inventory. Early in your accounting education, you likely heard about the qualitative characteristics of financial information. One of those characteristics is conservatism. Among other things, this principle says that when there is some uncertainty about a value within a company, the company needs to underestimate that value or take the lower of the two values. When it comes to reporting the value of a company's inventory, there can be some uncertainty. As we know from our other inventory videos, the value of inventory can change over time. It can become more valuable or less valuable. It can become damaged or even obsolete. Here's some examples. Perhaps a celebrity was spotted wearing a company's product and so its value increased. Maybe that same celebrity was recorded telling friends about how awful a different product was, so the value of that second product goes down. Or maybe a health organization reports that a product is no longer safe for human use. Suddenly, a store's inventory has become worthless. The point is, anything can happen. The value of inventory cannot be guaranteed, and so the conservatism principle applies. Businesses know the prices they pay for their inventories. Those are known values, and they're called historic values. They are the values that were paid to acquire or produce the inventory. However, the historic value may not be an accurate representation after time has passed, given the examples that I just described. Maybe what is more accurate is what the inventory can be sold for minus related expenses, and that's called net realizable value. The uncertainty can be summed up like this. Is a company's inventory worth what the company paid for it, or what the company can get when selling it? Now, net realizable value is only an estimate. It's the selling price minus the estimated costs to make that sale. It's not an exact science. It's based on past sales of the inventory or inventory that's similar. All of this means that there are two ways to determine the value of your inventory: the historic cost, or what the company paid for it, and net realizable value, which is how much the company can make by selling it. The conservatism principle says that companies must report the most conservative value. So when they report inventory, they have a policy that says raw materials, work in process, and finished goods are valued at the lower of cost and net realizable value. This is the first sentence from Canada Goose's inventory policy and the notes that accompany their financial statements. We now know that this means Canada Goose has a record of the historic costs it paid and has estimated the net realizable value, and on its balance sheet is reporting whichever value is lower. If the net realizable value is the lower number, then the company must create a journal entry to reduce the value of the inventory. When the inventory was first acquired, its value went into the company in exchange for payment. So if that value is no longer the most conservative value, a journal entry is required to write down the value of the inventory. One last thing that this Canada Goose example allows me to say is that a company needs to calculate each inventory type separately. This means that the value of raw materials would be calculated and reported separately from work in process and finished goods, and same with the others. A company isn't allowed to mix all of those values together. That could mislead creditors and investors. And speaking of creditors and investors, they don't only look at the values and the policies used to determine those numbers. They can calculate a few performance ratios to see how effectively the company is managing its inventories. Our first performance ratio is called the gross margin ratio. Before we get there, gross margin is the difference between the revenue earned from the sale of inventory and the cost of that inventory. Put another way, gross margin is the portion of your revenues after COGS that is available to meet other expenses, your taxes, and contributes, eventually, to your profits. Gross margin ratio expresses this value as a percentage of sales revenues. To calculate gross margin ratio, we divide gross margin by sales revenue. This will tell us what percentage of the company's revenues are retained for those expenses, taxes, and profits. The ratio is useful to investors and creditors because it provides them a value that can be compared to other companies to measure performance. Gross margin gives a dollar amount which can be compared, but that comparison ignores the relative size of the companies being compared. So let's look at a specific example. This company has revenues totaling $11,073 in 2019. Their COGS was $7,639. The gross margin is revenues minus costs of goods sold, which equals $3,434. The gross margin divides that $3,434 into the $11,073, and that gives us a gross margin ratio of 31%. One more time, that means that this company is retaining 31% of its sales revenue for other operating expenses, future taxes, and ultimately profit. Again, the ratio is an easier number to use when comparing this company's performance to the performance of other companies, preferably in the same industry. Look at these different companies' numbers. On the last slide, we calculated Company A's numbers. You can see that Company B's gross margin is smaller, but B's gross margin ratio is larger. In fact, among these four companies, the highest profit margin ratio, Company C, does not come from the highest gross margin value, which is Company D. I'm showing you these examples to reinforce the idea that the ratio is a more effective measuring tool or comparative tool than the raw dollar amounts. Our second performance ratio is called inventory turnover ratio. It calculates just what it sounds like. How many times a company sells through or turns over its inventory in a reporting period. To calculate this ratio, we divide COGS by an average amount of inventory, which is the average between the beginning and ending inventories for that year. We have an example here. We calculate the average inventory by adding these values and then dividing by 2. And that gives us an average of $101,459. We then divide COGS by the average value to get 3.72. This number means that the company sells through or turns over their inventory almost 4 times during the reporting period. They turn it over 3.72 times. Generally speaking, a higher inventory turnover ratio is better because that means the company is moving through its inventory more often. In other words, a higher sales rate or higher pace of sales. It does depend on the industry though, and we'll talk about that more in a minute. There are a number of reasons why knowing a company's inventory turnover ratio is useful, whether you're in the company or looking at the company from the outside. If you are an internal user, like a manager working for the company, knowing the inventory turnover ratio gives you information to predict when or how often you will need to make inventory purchases. Also, knowing the ratio allows you to make informed decisions about pricing and profitability. If the ITR is high, you could raise prices to take advantage of how quickly you're moving through your inventory. Or you could lower prices to try and increase the pace of sales. If the ITR is low, you can lower the prices to try to increase the inventory turnover ratio, or you can increase prices to make the most of each sale that you make. If you're an external user, such as an investor or a creditor, the ITR gives you an indication of how effective the company's inventory policies and systems are. If the ratio is low, perhaps the company is purchasing too much inventory given how long it takes to sell it. Maybe they should consider ordering inventory in smaller batches or moving their stores to smaller locations so they can reduce the amount of inventory they carry in store. Another insight is that external users can use the inventory turnover ratio of different companies in the same industry to compare the pace of sales in each company. For example, they could ask, How fast is one grocery market chain selling its inventory when compared to another grocery chain? Our final inventory-related performance ratio is called days to sell inventory. The names of these ratios aren't very creative or exciting, are they? The ratio calculates how many days it takes a company to sell its inventory. You can see the connection between this one and the inventory turnover ratio. Our example company's inventory turnover ratio was 3.72. They'd turned over their inventory 3.72 times last year. By dividing 365 into that number, we can determine that they turned over their inventory approximately every 98.1 days. Generally speaking, a lower number is better, because that means the company needs fewer days to move through its inventory. That indicates a higher rate or pace of sales. Like I said before, it does depend on the industry though, and to make that point, I use the analogy of tank tops and tanks. What I mean by this sort of absurd example is that these ratios are at their most effective when they are used to compare companies within the same industry. Generally speaking, retail companies like clothing stores and grocery stores, and manufacturing companies like companies that build things like tanks or jumbo jets or boats, are different in a number of ways, and this gives me my tank tops versus tanks analogy. The number of sales that retailers make in a reporting period is much higher than those of a manufacturer. As an example, think of how much inventory a grocery store sells every day and how many airplanes a company sells or let alone makes on any given day of the year. Because the sales volume is higher and the products are smaller, the sale prices are usually lower at retailers. Manufacturers, on the other hand, may produce only a few pieces every year, so the sales volume is lower, and in order to pay their employees and stay in business, they need to charge higher prices. Lastly, if a manufacturer is only making a few products a year, they need to make more money per sale, again, to stay in business. Retailers, though, can earn less profit per sale because they make so many sales each year. Well, it wouldn't be the complete accounting video experience if we didn't have a practice question. So please pause the video here and try to calculate the gross margin ratio for this company. All right, now let's take a look at the solution. To calculate gross margin ratio, we need gross margin over revenues. Gross margin is revenues, so these amounts, minus cost of goods sold, which gives us $561 in 2018 and $679 in 2019. So to calculate the gross margin ratio, we take our gross margin and divide it by our sales revenue, which in 2018 equals 50.5%. And for 2019, we take our margin divided by our sales, and that gives us a gross margin ratio of 54.2%, so a little better in 2019 than in 2018. Now let's try turnover ratio and days to sell inventory. Please pause the video one more time and answer this question. To determine inventory turnover ratio, we need to put COGS over average inventory. So this line, out of all this information, is the one that we need the most. Average inventory is going to be the average of these two numbers. 216 plus 211 divided by 2 equals $213.50. So to calculate the inventory turnover ratio, we take the cost of goods sold and divide it by the average that we've discovered, or calculated rather, and that gives us an ITR of 2.68. So this company turned over its inventory 2.68 times in 2019. To determine the days to sell inventory, we take 365 and put that over the ITR that we've just calculated, and we get 126.7, which means that the company turns over its inventory approximately every 126.7 days, which works out to about once every 4 months. I hope that those were the responses that you got, or at least you were close to these numbers. Sometimes there are rounding issues which will affect your dollar amounts or your decimals by a few points. If there were some major discrepancies, please go back and check your calculations and review this solution. And that's it. This is the final video in my inventory series. If you haven't seen the others, or maybe you're feeling like a little inventory review, you can click the links. Otherwise, I hope that you have found these videos helpful. Thank you very much. I will see you next time.
Thanks for watching this video made by my dad.